Let's study EA Capital's market temperature card to get a sense of where we stand in the economic cycle and what should investors expect going forward. In this video, we will first analyze the data in market temperature card, as on December 7, 2023, and then summarize our view in later part of this video, if we study different segments of the markets, in terms of large cap, mid cap and small cap. The Nifty 50, which is the large cap segment, offers an earnings yield of 4.46%, which means a PE ratio of 22.4, seems to be relatively cheaper, compared to mid-cap and small-cap segments. In valuation terms, Nifty 50 is followed by Nifty Midcap 150 at a PE ratio of 25.5. The Nifty Smallcap 250 index is the most richly valued out of the three segments with PE of 26.2. If we further look at bond yields, the India 10-year bond is currently offering an annual yield of 7.24%. The yields have cooled down, compared to our last reading in November, which is positive for Indian equities, and the same has translated into Nifty rallying over the last month or so. The American Dow Jones Index is trading at a PE ratio of 26.1, which means an earnings yield of 3.83%. Compared to this, the 10-year U.S. bond offers a yield of 4.15%. The U.S. bond yields have fallen significantly over the last month, which should give the U.S. Fed comfort to look at keeping interest rates stable and then in later part of calendar year 2024, start the interest rate cut cycle to give a boost to economic growth. Brent crude price currently stands at $74.83 a barrel. The crude oil prices have significantly softened, which is a big positive for Indian economy. A lower crude oil price means lower inflation for India and lesser pressure on India's current account deficit, which increases the Indian rupee's relative strength against other currencies. A strong Indian rupee is looked at very positively by foreign institutional investors. The India Volatility Index, also known as VIX or the Fear Index, is at a value of 12.67, which is higher than our previous reading, but still quite low, and this signifies complacency among market participants. We at EA Capital read a low VIX value as a contra-indicator and prefer to remain prepared for higher volatility in near future. Tickertape's Fear Greed Index depicts a value of 60.8, which is in the greed zone but not yet in extreme greed zone. We take the Fear Greed Index as a contra-indicator and have seen time and again markets showing resistance when it reaches extreme greed zone and support when in extreme fear zone. The BEAR ratio, also known as bond to equity earnings ratio, is at 1.62, which is arrived at by dividing the earnings yield of India 10-year bond at 7.24% by Nifty earnings yield of 4.46%. BEAR ratio has risen compared to our last reading in November, primarily because of the rally we have seen in Nifty 50, which has made the valuation of Nifty 50 pricier at PE ratio of 22.4 compared to last month's reading. According to our reading, the BEAR ratio at 1.62 signifies slightly above average valuations for Indian equities, but with very positive real GDP forecasts for Indian economy, expectations of improved corporate profitability in coming quarters, expectations of interest rate cuts after a few months, inflation remaining under control, strong flows into Indian equities. It looks unlikely that broader Indian markets will see a deep correction from these levels, and outlook remains positive for Indian equities from a medium to long-term perspective. The macro indicators continue to suggest very strong on-the-ground economic activity and growth. GST collections continuously remain very strong, with latest number at over Rs 1.67 lakh crore for the month of November 2023. Retail inflation has cooled down to 4.87%. With RBI repo rate at 6.5% already, it gives cushion to RBI to undertake interest rate cuts, once the global scenario permits the same. Along with GST collection number, both manufacturing and services PMI also signify expansion in manufacturing and services sectors, though the pace of expansion has slowed down compared to our last reading in November of 2023. Investors should note that a value of over 50 on the PMI index signifies expansion. Along with this, India's forex reserves have increased further, and stay strong at over $597.9 billion. Our forex to external debt ratio stands at a very healthy 97.38%. At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel. To summarize, our reading of the data says that the Indian economy continues to display strong fundamentals. Our real GDP growth outlook remains positive, and we remain one of fastest growing major economies in the world. Regarding flows into Indian equities, for the month till December 7, 2023, foreign institutional investors have bought shares worth net rupees 7,242.42 crore, while domestic institutional investors have bought shares worth net rupees 6,208.57 crore. In the month of November, foreign institutional investors bought shares worth net rupees 7,032.61 crore, while domestic institutional investors added equities worth a net rupees 226.28 crore. Markets seem to have digested the fact that there are geopolitical tensions across the globe and seem to continue their upwards journey, as global markets are factoring in that interest rates are close to peaking out, and hence markets are anticipating lower interest rates. The US and Indian bond yields are already showing lower interest rates, which is great news for equities as an asset class, as it improves liquidity and makes fixed income less attractive. Lower interest rates also spur economic growth, as cost of capital gets cheaper and it's easier for corporates to expand their operations during cycles of falling interest rates. Investors must also be aware of risk factors which can dampen the positive sentiment for Indian equities. These may be: A. Uneven distribution of monsoon, hence rural economies' growth can remain under pressure. B. Escalation of geopolitical tensions and involvement of other countries in the war between Israel and Palestine can potentially take crude oil prices higher, hence higher global inflation and higher for longer interest rates, which can derail and slow down economic growth. Higher crude oil prices for longer periods of time can negatively impact India's current account deficit and forex reserves, and can pose pressure on Indian currency, thereby negatively impacting foreign flows. C. After the recent state election results, markets seem to be pricing in political stability and continuation of reform process after the upcoming general elections in 2024. Election results otherwise may possibly create upheaval. D. In equities, many unforeseen risk factors, which are not mentioned above, may have a significant negative impact in near term, though, in long term, earnings growth of investee companies tends to decide the returns earned by investors. What we would do with our portfolio: we will continue to remain focused on asset allocation in terms of equity and debt. We plan to stay invested in quality Indian equities, primarily through mutual funds, and along with it stay invested in high credit quality debt and high credit quality ultra short-term or liquid funds to have liquidity available to take advantage of the inevitable volatility in equity markets. We also plan to rebalance portfolios at opportune times, from pockets which we feel may be overvalued, or if asset allocation between debt and equity deviates too far from our decided percentage allocation between debt and equity. Please note that the comments and views shared in this video are our personal views, as per our own understanding, and this should not be treated as any recommendation for buying or selling investments of any kind. Investors must do their own independent research, consult their investment advisors before making their investment decisions. We have done our best to ensure accuracy of data shown in the market temperature card, though, in rare case human error may be possible. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you.